What's happening, guys? Hope you're doing well. Hey, today I want to walk you through a scenario that we're seeing more and more often on our side. And it's this fact that we've got buyers sometimes that come to us and they already own a home. They want to maybe move up. They want to sell the existing home and move that equity into the new one. And when they're kind of doing the math, that the numbers aren't penciling. They got really good terms on their existing loan, looking at the new price point, they're looking at the new rates, and they're going, it's not going to work. I would love to make the move. It would be beneficial for us. Maybe we need that new that extra space, that new bedroom or the additional bedroom, maybe we want the pool or the better neighborhood. We just can't seem to justify it. So I came across an app that, came over to our office the other day, and, it made a lot of sense after we got a chance to kind of unpack it and build out a scenario for them. And I thought it'd be worth kind of exploring and sharing with you guys. But first, I want to kind of explain a little bit of a backstory as to where a lot of people are. And this may be you, maybe it's somebody that you know, but kind of want to understand why we're seeing such low inventory right now, because a lot of people feel like they're handcuffed to the existing loan and terms that they have, and it doesn't make any sense for them to make that move. And so because of that, those homes will never hit the market. We desperately need those right now. We have really, really low inventory. So I'm going to share a screen with you real quick, give you a little bit of backstory on this, and then we'll jump into the case study here in just a second. So this first slide that I'll bring up, this is a survey that was done, and it was basically anybody that bought prior to the pandemic. And so this survey was done after the pandemic, and they're hitting these people up and they're going, hey, what regrets do you have? Tell us a little bit about your home buying experience. And I thought this was really shocking. You had people that said, 30% said, I spent too much. 26% of the people that had regrets said they bought too quick. They felt rushed. And if you remember during that time, so from 2020 through 2021, there were a lot of offers that were made, sometimes sight unseen. I remember talking to some people that they were buying this house literally on like a FaceTime call with their real estate agent. They were walking them through, looking at the house. They hadn't even had a chance to go into the home themselves, but yet there were multiple offers coming in against it. And so because of that, they were getting so desperate, they just had to write an offer. They never even, they felt a little bit rushed. They never got a chance to actually kind of sit with it and feel it. It's very different than that now. The home requires too much in the way of maintenance. This is just maybe some pre-planning. When you own a home, sometimes you have to figure out, what the anticipated maintenance is. How old is the home? What kind of work has been done to it prior to your ownership? Because a lot of people didn't have a lot of time to do the research on it. They're saying, hey, this thing needs a lot of work. We didn't realize that when we bought it, but now that we're in it, it needs a lot of work. A lot of them regret buying a fixer-upper. Same thing. The cost to do all the repair work. If you're handy, you can save on the labor, but you still have all the cost of materials. If you're not so handy, you're having to pay those labor costs, which are significantly more, plus the material cost. So the fixer-upper, the idea behind it is great, but in practice, it's probably a lot more expensive than a lot of people think. There was a lot of pressure to make an offer. So remember, again, like we mentioned, a lot of offers that were coming on the table at the same time. And so there was this pressure to kind of make a move really quick. Bought sight unseen. Don't like the home's location, don't like my neighbors, and just flat out don't like my home. So why do I bring this up? I bring it up because, there's people that are in their home right now that made a really, really fast decision. And if you're anybody that fits this profile, then you actually have an opportunity. You probably have a little bit of equity, probably not a lot, but a little bit of equity. And if this isn't the right home for you, it's probably the right home for somebody else. And again, because we need inventory, this would actually be a decent time for you to list your home for sale. You've got willing buyers that'll come in and buy it at a good price and just enough to get you out of it and get a little bit of cash to go into the next one. But it gives you the opportunity to spend just a little bit more time on the next purchase. So it would be something worth considering if any of this is kind of you. So I know they didn't survey everybody, but if you're one of those people who was like, yeah, that's definitely me, consider it, at least run the numbers and see what it kind of makes sense doing. You could be one of these other folks. And this is where I want to spend a little bit of time, people with a ton of equity. So in this pie chart right here, 38.7% of all of the homes in America are owned free and clear. There's no mortgage on them. Okay. Nobody owns a thing. It's owned outright. Nobody owes a bank any money or anything like that. 28.9% have more than 50% equity. That's a ton of equity. We've had this big run up in our home values. And so because of that, we have homes that are owned free and clear. People have just been diligent about paying them off. and then 28% that actually have 50% or more in equity. Homes with less than 50% equity, it's only 32%. So 32% of all the homes out there have less than 50% equity. So this means that we have a lot of choice. We have equity, we have money. Now we can do stuff with that. So I think where the disconnect is and why a lot of people are kind of locked in is don't know what to do. They need some financial strategy around, could I make that next purchase make sense, and would it be worth it? And, what are the things I need to avoid so I don't make a mistake on it? This is another chart kind of in the same context. It's just showing the household mortgage debt as a percentage, of the value of the home. So, if we go back to, 2010, 2012, 2014, right in this range, we were right up here, we're about 50% of the value of the home, right? So we were leveraged a lot higher. Now our leverage is much, much lower, is a total sum. So all the homes that have financing against them, we're well under 30% of the actual value of the house is actually financed. So again, tons and tons of room there. This is another reason why foreclosures are likely to not happen, because if the average has tremendous equity in their house, if the market did roll back a little bit, or they ran into a household situation where they maybe had job loss or a death in family, something like that, there's plenty of equity to sell that home and walk away, not necessarily give it back to the bank as a foreclosure. This chart, you may have seen it in the past. This is actually in our forecast for 2023. But I want to kind of revisit this one. This is interesting. You've got credit card and revolving debt. So this is all of our debt that we're not supposed to really carry month to month, but a lot of people do. They end up kind of putting furniture, different life expenses on a credit card, and they carry it a little longer than they should. And back in 2020, when we were in the height of the pandemic, you can see this nice little run up. We were spending a little bit more than we needed to. These are billions of dollars, by the way, over here. So at the peak, right about $860 billion in credit card debt. So a ton of credit card debt. But look at fell off of a cliff, just really fell off, because what happened, we couldn't travel. We were restricted to stay home. And so we didn't spend, we didn't go out to eat. We weren't traveling. We weren't spending the money on stuff that we really didn't need, because we were locked up. We were at home. We couldn't do anything with it. Well, then all of that started to relax. And as it started to relax, the consumer spending started to kind of take shape again. It started to go and ramp back up. And now, if you kind of look at it, we're well over. So prior to the pandemic, 860 billion. Now we're sitting somewhere around, $930 billion, almost $1 trillion worth of credit card debt. So it's an enormous amount of debt. Down here, almost during the same timeline, this is a similar timeline right down here. You can see this is consumer savings. So our savings, when we stopped spending on our credit cards, our savings actually went up. It's kind of the complete inverse. So we didn't save as much. We just kept a little bit more money in our pocket. Maybe we paid off some of our credit card debt, but we're actually saving, just as a society, a little bit more money. That started to kind of wane. And you can see this general trend down where the savings rate is a lot less. Also in this right here, there were some stimulus too. So that also aided. Remember, stimulus packages were coming out for people who may have lost jobs, or if you're a business owner. And so some of that aided in our personal savings as well. This is one of the most telling slides, and I want to spend just a few minutes on this real quick. So 80% of all the borrowers that have a mortgage rate is below 4%. When rates are up in the 6-7% range, it's really, really hard for you. Just everything is against us to say, I want to trade my mortgage that's below 4% for something that's significantly more expensive. It's not just mortgage. You run into the same thing in autos. If you had a car that maybe was a little bit too old or doesn't serve you anymore, but your auto terms, you had a 2.75 rate on an 84-month loan, you're not going to jump into the brand new car when they're offering 7 or 8% at the bank. It's really hard to do that unless it makes economic sense, and there may be more to it. And so we see that sometimes in mortgage, is that because it's such a large debt, it carries this really, really heavy weight to it. And it's like, look, if it's below 4%, I'm not touching that thing. If I have a rate that starts with a 2 or a 3, we're just going to suck it up and live here, even though the home no longer fits us, or we could really benefit from a move. So I want to kind of bring that part up. This was just a really telling look at how many people are sitting at 3%. or 3.5 or 4, you can just see there's just tons and tons of people that are sitting in there, and they're really kind of trapped by that. So let's check out this case study, all right, and kind of follow along with me on this one. I'm going to walk you through a couple of different concepts of how somebody's able to make this move and this transition work. Which one works? It depends on who you are, and that's why I wanted to kind of outlay a handful of them for you, so you could kind of check those out. So here's kind of the summary. So this is the decline. They had a value about 585 on their current house, 293, 147, and their interest rate was 3.25. We refinanced them way back when the rates were much lower, and so they were at 3250. This payment down here of 4531 is actually their payment including their consumer debt. So you can see right over here off on the right hand side, principal and interest was 1407, property taxes 536, hazard insurance was 140. Their mortgage is about 2083, but they have 2448 in non-mortgage debt, so autos, credit cards, etc. All right, so their total outgoing, even though the house is only 2083, total outgoing is actually 4531. Just kind of a list real quick, just so you can get some context around what this individual's profile looked like. So Toyota Financial, 48,699 at 4.99%. The payment was 816. Another auto with Allied was 32,000 and some change, 6.49 rate, 598 a month. And then there's a handful of credit cards. You can see where the interest rates were on those and what the minimum, these are minimums, by the way. This isn't throwing extra big chunks at it to get this paid off on the credit card debt. So that total minimum was 2448, right? And let's take a look at a blended rate. So again, the mortgage debt 3.25, we don't want to touch that, right? Because it's such a good interest rate. You're not going to get those terms right now. But look at the rates that they're paying across the board. So the total of debt, even though the mortgage is 293, the total debt's 425. And even though the mortgage is 3.25, the blended rate was 6.065%. So paying a little over 6% all the way across the board on all of the debt. So now we're actually probably closer to what reality is, for a new mortgage. So let's take a look at what they can do. So their option is to sell a home at 585. They're going to have estimated selling costs, and I just kind of ballpark this. I don't know what they're going to get charged to sell it with the realtor or any of that stuff, but I just kind of put in 46K. I didn't sugarcoat it. Let's just kind of put it in for what it is. That number is about 8%. So I used it for escrow, for title, any of the selling cost, broker commissions, etc. Let's just dump all of that in there so that we're not looking at it as a best case scenario. That's probably very realistic, if not maybe padded just a little bit. The mortgage balance of 293, so their net profit after they sell their home at 585 would be $245,000. The non-mortgage debt, going back a couple of slides, was $132,000. So they actually have available, after they pay off all their debt, if that was the way we go, $112,000 to work with. So this was what our option looked like. To get into the house that they were in, they didn't need to go crazy. They weren't going to like $1 million, but 585 was, the value of their house. And the one that really kind of fit their need they could get it for about 750. And so this is our scenario. So 750, they get a loan now for 525. And let's say the interest rate was 6.75 at the time. That mortgage payment is 4326. Their total cash to close, $242,000. This would be really hard to do because they also had that non-mortgage debt, right? The cars and the credit cards were $2,400. And we actually just took all of the money from the sale and we dumped it into the house. That's this scenario right here. This scenario over here was basically saying, hey, let's just look at a move up. Let's consolidate all the debt. Let's get a more expensive mortgage. And I know what you're thinking. Why the heck would you do that? We're going to pay off the $2,400 worth of consumer debt, and we're going to take out a new mortgage here. And then we're going to look at what it would be if you were to pay it off early. And then lastly, kind of move this out of the way, what it would be if you were moving up and investing the money. So we're going to see how those scenarios kind of pencil out over time. So this is what it would look like. So their total spend, if they took all of the money from their sale and they bought a house at 750, you've got a payment of 4326. You got your non-mortgage debt of 2448, and you have a monthly payment of now $6,774. Over here, if you consolidate everything, now you put less money down, so you're going to leverage the mortgage more. You got a bigger mortgage payment, which is, again, very scary. got mortgage insurance. You can see that right here, that $159. Everybody hates mortgage insurance, but look at what's doing. It's allowing you to leverage the mortgage a little bit more, and you have $5,361, way higher than the $2,000 and change that they were already paying, except their total outgoing was already in the $4,500 range. And so it's not that much further from where they were. This $5,361 is way cheaper than paying a total of $6,774. Remember, they're moving up. So utility costs are going to go up a little bit. There's going to be other factors that we need to consider. So we need to get that cost down as low as possible. So in this scenario, this would help them. Now let's assume that they could make that payment of $6,774. And we still consolidate the debt, but now we take the savings, in this case, $1,412, and we throw it right at the principal. So now at will, we can do that. We could turn that on or off. All right. We could do that for 5 years and then decide that we need to save some money and quit sending the $1,400 if we want to. But in this case, we're going to simulate, we're going to send $1,412 to the principal. We're going to commit to it because we're already used to paying that other consumer debt. Let's just wipe it out and then let's send it all, purposefully to get the mortgage paid off, because this is scary. We don't want to owe too much. Let's get it paid off. Over here, we're going to kind of do something similar, except we're going to send it to an investment account. So we're going to send it to this $1,412 to an investment account, and we're going to make some interest on that. What we're going to use for the investment part of it is we're going to use an 8% compounded annual return. So this mix would be totally different if you were working with a financial planner. You might want to check with them. I just did some quick research and found that a healthy mix, a 60-40 portfolio, 60% stock, 40% would be bonds and other items in there that are more safe, that are going to get a lower return over time. We're not loading this thing up and simulating making 11, 12, 13, 14% just all stock. So we've got a really healthy mix. This would be something very safe. You can expect somewhere around an 8% return if you're working with a good financial planner on that. So we're going to use that for the investment component. This is how it all kind of shakes down. So if we look out 30 years from now, and we use a very, very conservative 4% property appreciation over the entire span of 30 years. Now, this property happened to be in LA County. And when I look at LA County and I look backwards 30 years, the average appreciation is over 5%. We're only using 4 in this case. So this is really hard for us to kind of imagine. Buying a house for $750, 30 years from now, the home value, $2.4 million. Hard for us to kind of fathom that, but it's totally possible because we look back 30 years, house prices were way different than they are today. And the average rate of return is actually, it's like 5.5% in LA County. So we're using 4%. We're being a little bit more conservative on this number. So if they applied everything to the new purchase, they would have a net worth at the end of that 30 years of that $2.4 million. They've got the value of their house kind of built up into their net worth there. And you have the same thing here on the move up. So this would essentially, without throwing anything else, you saved along the way, you saved on your monthly payment, you didn't throw any extra to the principal, you're going to come out the same because the value of the home is there and you got the home paid off in 30 years. But if you were to send extra money to principal and you would pay that home off, I don't think it shows right here. Apologize. Let me go back a slide. It didn't. It actually was, it was like 15 years and 5 months, something along those lines. That's when you paid the home off. So sending an extra $1,400 paid it off a little bit faster. And what happened is now with the 8% return, after you paid the home off, you could send the $1,400 plus the principal and interest to an investment account. So you get the home paid off first. That's the safe approach. You're taken care of there. Now you're used to spending that money at the 15-year mark, or about halfway through the 15-year mark when the home is paid off. You just start sending and kind of supercharging a retirement account. You would end up at 30 years, you would end up with an investment balance. Your house is paid off. You've got $2.4 million worth of equity, but the home also was able to, because you sent money to an investment, you've got $1.8 million in the investment account as well. So your total net worth now is $4.2 million. And over here, this is the move up strategy. So this one, I said, look, let's send all the money that we can originally, make the minimum payment on the mortgage, but let's send the difference. Instead of paying the principal down, let's send it to an investment account. Let's do that from day one. And if we did that, and we ask it when I have enough money in that account to pay off my mortgage, I want to do that. I want to just sell it off, sell the shares and transfer it and pay that off. If we do that, Then at the end of 30 years, you would have $2 million in that account. And again, that property worth 2.4 million. So your net worth 4.446 million. And this is just based on these little moves right here. This isn't taking into account, any IRAs, 401ks, any other assets that you've been able to build over time, but just kind of using this strategy right here allows us to get to the finish line with, more than double what we were originally kind of looking at if we were just simply paying off the mortgage and then kind of sitting pretty on that. And a lot of people are worried about the mortgage. They want to pay that off really quick, but I would challenge you to look at some alternative strategies and shift some of the money from those consumer accounts like credit cards, auto payments, and things like that. Instead of that money going out there, let's repurpose it. Let's invest it, or let's get it to go toward the principal of your house so that we can drive more money to your bottom line in the future. All right, this is just another slide here to show you an example here. This in green would be the home's equity. And then in this kind of salmon color or tan color, baby puke orange, I guess, would be the investment account, right? The asset. So this kind of shows you by graph how much extra cash you have here. This is also really important too, just as a side note. If something drastic happens here, and we don't have enough money up here in a liquid asset, you have to go re-leverage the mortgage, right? You need to go get a new loan. You need to sell the house, something to get that money back out, because that money is just sort of there on paper right now. This, you can go and a couple keystrokes in a few days, you have the money. If you sell some shares or you liquidate, some of the assets, you have that money in your hand. You didn't have to touch the house. You didn't have to sell it, didn't have to remortgage it, which we know takes, it could be a few weeks to get the money on that. So a lot quicker and safer, in my opinion, to do that. All right, guys, hopefully that helps you. I just wanted to walk you through that. That was a scenario that really kind of struck it with me, and I thought I would share with you. I'm happy to run through any scenarios that you have. That QR code right there, if you scan it, it'll take you right to kind of our landing page. You can get in contact with me there. You got all the rest of the contact info right in front of you. We look forward to connecting with you here very soon, and I appreciate your time. All right, we'll talk to you soon.